Hello friends, today's topic is background of Beps. Herein we will be studying what is the meaning of Beps, what is the intention of OECD in introducing action plan, which are 15 action plans which have been introduced by OECD to counter Beps, which is base erosion and profit shifting. So friends, starting with the background of Beps. Beps is nothing but base erosion and profit shifting. It means MNCs are adhering to Beps are adhering to profit shifting, wherein they are able to minimize the overall corporate tax liability. And mind you, they are doing this legally under the tax planning, which is legally allowed. So the respective governments are also not able to challenge these strategies. Cut start are not able to challenge this strategy. So to counter attack this strategy, wherein MNC are lowering their corporate tax liability, overall corporate tax liability, BEPS counter action plan have been introduced by OECD. So first of all, just to give you background, how does it came into picture? How come MNCs are in a position to influence their corporate tax liability at such a lower rate? So first of all, the globalization. Because of globalization, no doubt there has been benefit to the respective countries. Developed countries are able to expand in developing countries and in the process are able to obtain profits in the form of royalty, intellectual property, and developing countries are able to use those intellectual property, and also there has been investment in developing countries which is helping the economy, which is helping the infrastructure to grow overall. So it's a mutual benefit for all the countries which are involved in globalization. It is not only helping MNCs, but it is also helping domestic companies. However, MNCs company are at times in a position to even have a upper hand than domestic companies, wherein they are able to save taxes and accordingly bring economies in scale and accordingly bring the cost of the product at a lower price and sell in the developing economies. So they will be in a better position as compared to the domestic companies, only because the tax rate that they are paying, because of effective tax strategies, effective tax planning, they are able to lower the tax rate and accordingly the cost of production overall is coming down and they're selling products, services at a much cheaper rate as compared to developing economies. So MNCs globalization may be benefiting all the economies, but somehow due to the tax strategies being followed by MNCs, there has been an issue whether this practice can continue or not. And if it continues, it will hamper development of cut start. It will hamper the development of the countries which are not developed, the companies entity which are other than MNC. On your screen, first is globalization, benefited domestic economies, yes. It boosted trade overall, yes. Increased FDI increased investment. These are the benefits of globalization, wherein, as we have discussed earlier, investment increased in the developing economies, and the funds got start, and those funds were diverted for the development of infrastructure of the economy. Unrestricted movement of capital and labor. You might have heard that there is expatriate movements. A people, a skilled labor is moving from US, UK, and is coming to India and is providing training to people in India. So there is unrestricted movement of labor, unrestricted movement of capital, meaning the MNCs are dealing in goods and services as if it is part of the same country, it is part of the same territory. So there has been no restriction as such in the movement of capital, in the movement of labor, and this is helping the companies to overall grow and to expand their business. And significant impact on a country's corporate income tax regime. Globalization has significantly impacted each and every country's corporate tax income tax regimes also, wherein the domestic provisions are required to be altered day in and day out to address the concerns of domestic companies. Either if domestic companies are not at par with MNCs, they are not able to compete with MNCs, then certain amount of provision may be provided to domestic companies. Or if there are backward areas in a particular country, then incentives are provided to a company to establish their factory, to establish their business in such backward area, so that in a longer term that backward area will develop and that will help the people staying over there. So globalization is a overall benefit for each and everybody, but the only thing is MNCs are involving into practices which through which they are lowering the income tax rate, the corporate tax rate, and this is having a negative impact on rest of the parties. Now second, e-commerce and consequent aggressive tax planning. So e-commerce, friends, is another term for internet, wherein the players involved are the major players involved are Google, Amazon, Flipkart. Each and every person who has a major presence on internet. Because of that, there has been, you know, significant impact on the way we deal with goods and services. Because initially, if you see, more than 5 years ago, we used to trade in goods and services through a physical movement of goods. We used to physically visit a shop and purchase goods, purchase services. Now, it's like if you have an internet, through mobile, you can purchase goods. Through mobile, you can also avail services. You can also call for certain services. So things have changed only because of e-commerce. There is boom in e-commerce, and accordingly there has been issues in digital taxation. How to tax those e-commerce transactions has been an issue, has been a matter of litigation. And such e-commerce entities have indulged in aggressive tax planning meaning they have remained within the tax boundaries, they haven't done anything wrong, it's only that they have used the available option, available tax planning strategies, and accordingly they are able to lower their corporate tax rate. So initially there was a need to eliminate double taxation when a company used to move from when an MNC cut start where an MNC used to move from one country to another country. There was a fear amongst MNC that the same income would be taxed not only in the residence country but also would be taxed in the source country, and they will be in a way cut start, and they will be in a way paying taxes which will be much higher had they been in their domestic country only. So to provide incentive to globalization, to provide incentive to such MNCs, double taxation avoidance treaty came into being. The TAA came into being, wherein as such MNCs they assured that there will be no double taxation of the same income in the hands of MNC. Accordingly, the source country rule, the resident country rule came into existence, which we will be discussing in detail in the chapter Model Tax Convention. So there is a separate chapter which deals with resident country, source country rule, and the overall structure of the double taxation avoidance agreement, and the basic intention, the basic purpose of DTAA, double taxation avoidance agreement, is to avoid double taxation of the same income in the hands of MNCs. Not only MNCs but other entities as well who have their presence in more than one country. So there was a need to eliminate double taxation, and that was addressed through double taxation avoidance agreement. Now, because of the e-commerce and consequent aggressive tax planning, what is happening is there is a need for avoiding non-taxation of the income, meaning treaties came into place to safeguard entities, to safeguard global entities, to safeguard them from double taxation. And because of the aggressive tax planning, now OECD has come with an option wherein they have to avoid non-taxation of a particular income. Meaning, because the overall tax liability is reduced, there has been situation wherein the same income is not taxed at all. So in order to avoid cut start, so in order to avoid non-taxation of an income, BEPS has come into place. Action plan for BEPS have been introduced by OECD. On your screen, need to eliminate double taxation. International tax laws facilitate in the development of global economy. No doubt, international tax law, meaning the double taxation avoidance agreement, the assurance to the MNCs that their income won't be taxed doubly. There will be no double taxation. Once such an assurance was provided by double taxation avoidance agreement, so globalization flourished because of that, and accordingly this point wherein international tax laws facilitate in the development of global economy, multinational enterprises MNE representing a significant portion of global GDP. So here you can see MNCs, MNEs have a larger share towards global GDP. They play a major role in global GDP, and if such MNEs will lower their overall corporate tax rate by indulging in aggressive tax planning, then this will affect each and every country in which they are involved. So that is why the need of action plan for BEPS. Intra-firm trade, meaning MNCs with their holding company, subsidiary companies are more indulging in intra-firm trade, and because of that, related party transaction, associated enterprise transaction, transfer pricing provisions have come into place. Just that, just as a measure for anti-tax avoidance rule. Increasing significance of digital products, increasing use of internet, tax planners identifying and exploiting the legal arbitrage opportunities, and encouraging MNEs to minimize their tax burden. So, the aggressive tax planning being considered by MNEs has been highlighted over here. So till now we have covered 2 points on the background of Beps. First is globalization and picture of MNEs where they are involving in aggressive tax planning which is not helping the global GDP. Now what are the adverse cut start? Now what are the adverse effects of Beps? So before going into what are the effects of Beps and you know what implications it has, first of all, the exact meaning of Beps. Beps full form is base erosion and profit shifting. In this, MNEs are indulging in aggressive tax planning, wherein they are able to lower their corporate tax rate or they are able to erode the base, erode the income in a particular country, where they are able to shift their profits from a particular country to a country which is a tax haven, to a country where the overall tax rate, where the tax rate is minimal or there is no tax rate involved. As an example, suppose take there are three countries: US, India, and Maldives, wherein Maldives is a tax haven country, for example, and there is no tax payable therein if you make an investment. So MNC, ABC MNC, what they have done is, it is based in US and they have subsidiary in India as well, but they have made investment not directly in India but through a tax haven country. Through Maldives, they have made investment in India, meaning there are three entities effectively in US, in Maldives, and in India. US company is investing in Maldives, Maldives company is investing in India. And when they have earned the profit from India, they are diverting funds not directly to US, cut start, not directly to US, but the funds are transferred by way of dividend to Maldives and the tax rate therein and the tax rate therein is nil, and what they are doing is they are showing deductions therein, artificial deduction you can say, wherein they are not paying any taxes. And ultimately what is happening is, this was just a hypothetical example, we will have to get more in detail, I mean how the overall structure works, and further detailed analysis is required. Just to give you a plain vanilla example, this is how the structure will be, wherein a country, a conduit company is established in a tax haven company and treaty benefits are derived between the respective treaty partners. So, and the profit is shifted, the profit is artificially shifted, in an example from India to Maldives. Income is artificially shifted from India to Maldives in such a way that the overall tax liability of MNC gets reduced or it is negligible, or it is nil. So there is base erosion, profit shifting from a economic generating country, from the source country. There is base erosion, there is profit shifting to another country which is a tax haven country. Ideally, it should have been taxable in the source country or in the resident country, but the funds are flowing to the tax haven country and benefits are going to a tax haven country. And this is how MNCs are indulging in base erosion and profit shifting, and because of that they are able to reduce their overall cost, and which in effect is affecting their competitors. So friends, base erosion and profit shifting refers to explaining strategies that exploit gaps and mismatches in tax rules. So in a way there are gaps and mismatches in tax rules, meaning the international tax rules, in effect they have been prepared by a human being only. So there is bound to be some or the other mistake in it. So such gaps are analyzed, such mismatch loophole are analyzed and are used for the purpose of reducing the tax. So such gaps are exploited to make profits disappear for tax purposes or to shift profits to locations where there is little or no real activity, but the taxes are low. In our example, Maldives, tax haven country. Again, base erosion and profit shifting refers to explaining strategies that exploit gaps and mismatches in tax rules to make profits disappear for tax purposes or to shift profits to locations where there is little or no real activity but the taxes are low. This is very important definition of Beps and the meaning of Beps. So what are the adverse effects of Beps? As we have discussed, it affects MNC's competitors. It drastically affects developing countries wherein actual funds won't be at the disposal for developing infrastructure. Also, domestic companies of the developing countries are severely affected. You might have heard, practical example if you want, you might have regularly heard wherein how Amazon and Flipkart are providing discounts, are able to provide discounts, and how it is affecting the domestic players, the domestic retailers. So this is how, if at all, Amazon, Flipkart are able to reduce the tax liability, then those benefits may be reflecting in the products and services that they are selling. So they are able to reduce their product price at a very low price as compared to the domestic retail players. So this may be called as an adverse effect of Beps. On your screen, this helps MNE to underreport the actual income through base erosion. In developing countries, the lack of tax revenue leads to significant underfunding of public investment that could help foster economic growth. So infrastructure is hugely affected through underfunding of the public investment. Actual funds should be at the disposal of the government. However, since there has been shifting of profit, since there has been base erosion, legally they are doing this. Hence, actual funds are not at the disposal of the government and they cannot invest the funds in the infrastructure of the economy. Tax fairness issue, meaning the individuals, the rest of the entities other than MNCs are paying taxes regularly In India, the tax rate could be as high as cut start. In India, the tax rate could be as high as 30%. So entities other than MNCs are taking the tax burden. They are not able to indulge in this aggressive tax planning, and they have to pay tax which may be at 30% or more. And the MNCs, as compared to the local entity, are paying tax at a single figures, at a nominal rate, or even they are not paying any taxes. So you can see the difference in tax rate, and in the long term it hugely affects the cash flow of the respective companies. So tax fairness issue, meaning that this is not fair how taxes have been paid by MNCs by other entities. Accordingly, such domestic company, it is difficult for them to compete with MNEs. To address this issue, OECD suggested a need for international collaboration. Avoiding double taxation has been addressed through double taxation avoidance agreement. However, double non-taxation is to be addressed, which they are proposing to address through Beps. And there is a need for coherence in the international law. This is one of the three pillars of Beps action plan, wherein the meaning of coherence is, let's take an example wherein the Indian government, if you see, there are provisions wherein, let's take an example wherein you are paying, you have taken a housing loan and you are paying interest on the housing loan. So this interest amount will be allowed to you as deduction under section 24B, and it will be income of the financial institution to whom you have paid interest. So in one hand, from the point of view of the government, in one hand they are providing deduction to an individual, to the borrower, and on the other hand there is an income in the hands of the financial institution. Accordingly, if they are giving deduction, they are ensuring that the same deduction is an income in another person's hand, and accordingly taxes are paid by such financial institution. They will make sure that income that taxes on such income has been paid by the financial institution. So from the point of view of the government, they are able to keep a tab on such things. There are provisions, there are protocols in place wherein they are able to trace out if the financial institution is not paying any taxes on such income. Similarly, this coherence concept that we discussed was for domestic provisions. Now the same coherence concept needs to be brought in the international law, wherein if one country is giving a deduction, then another country should ensure that such income, such tax on such income has been paid by the MNC. So the overall plan of OECD is like, OECD will be a watchdog in which countries should ensure, country A, country B, you make sure through transparency amongst yourself, through exchange of information amongst yourself, make sure that that particular MNC has paid applicable taxes on such income. So the concept of coherence needs to be brought in the international law as well. So the need for international collaboration is to address the double non-taxation and to bring in cut start and to bring in concept of coherence in the international law as well. Now friends, after understanding the background of introducing Beps, let's understand year on year what were the developments in introduction of Beps, and today as on date what is the situation. So overview of Beps. In Feb 2013, the OECD published a report on addressing base erosion and profit shifting. So it all started in 2013, Feb 2013, wherein OECD published a report. Cut. Start. Wherein OECD published a report for addressing Beps, and the OECD members and other non-members as well were invited to address this issue. In June 2013, OECD published draft action plan on base erosion and profit shifting, which is Beps action plan. So the 15 action plan which we are talking about, which we'll be discussing in detail in the subsequent slides, this Beps action plan came into picture. The draft version came into cut start. The draft document came into picture in June 2013, and it attained finality in October 2015. So the final document came into picture in October 2015, and thereafter there has been almost 5 years, and as on date, if you see, from October 2015 till date, what OECD has suggested is, first of all, the member countries has to ensure, for example in India, so there is instruction from OECD that there should be introduction of certain domestic provisions to realign the India income tax with the international tax laws. So the purpose is, there are a set of international tax laws which is recommended that a particular country should follow, and if there is any discrepancy, then a time limit is given to each and every country so that they can realign their domestic income tax provisions with the international tax law. So from 2015 till date, India has introduced, in fact, various domestic tax provisions to realign its India income tax domestic tax provisions with the international tax law. That also we'll be discussing in detail, action plan wise. Next point, the Beps action plan identifies 15 action points to address Beps in a comprehensive manner and sets a deadline to implement those actions. So as we discussed, after October 2015, the member countries, OECD member countries, were supposed to realign the domestic tax provisions with international tax law, and in effect there will be peer reviews also, wherein somebody from OECD team will cross check and report it to OECD that whether indeed a particular country has realigned, has taken measures to realign their domestic tax provisions with international tax law or not. So there are frequently peer reviews on the same, and the particular country has to make sure that they are taking firm action plans which are recommended, which are mandatory as per Beps. It could be certain action plans are mandatory to follow and certain action plans are voluntary to follow. So next one, the action plans were structured around three fundamental pillars. Three fundamental pillars are coherence, that we discussed earlier, substance requirements, which is nothing but substance over form, transparency and tax certainty. These are the three main pillars of action plan on which basis the action plan 15, total number of 15 action plans have been built up, have been prepared. So coherence, as we had discussed earlier, is nothing but where a particular income is a deduction for one person, it is an income for another person. So there should be protocols in place wherein both the countries, country A and country B, source country and resident country, should ensure that income is taxed in the hands of the particular MNC, the particular entity. This is the coherence concept in international tax law. On your screen, introducing coherence in the domestic rules that affect cross-border activities. So, there are already rules to check this coherence concept in the Income Tax Act, in the domestic tax provisions of the company, where the transaction is within that particular country only. Through Beps, what OECD is recommending is you should be ensuring that such coherence concept is applicable for cross-border activities as well. Substance over form requirement, simple concept. The concept is prevalent in the India Income Tax also, India Income Tax Act also, wherein the beneficial ownership will always be prevalent and legal ownership is not to be seen. Whenever the taxability is to be determined, the taxability of income will be in the hands of beneficial ownership and not in the hands of legal ownership. Simple concept is section 64, wherein an asset has been transferred to a spouse without adequate consideration. So we have studied that the same is clubbed in the hands of the asset provider because the asset has been provided without any adequate consideration, meaning the legal ownership is though with the spouse, but the beneficial ownership is with the SSC only. So difference between beneficial ownership and legal ownership, beneficial ownership will prevail, and this is what the concept is of substance over form, and this requirement needs to be adopted in international tax law as well, wherein the beneficial ownership is to be seen and accordingly income will be taxable in the hands of beneficial owner. Reinforcing of substance requirements in existing international standards, alignment of taxation with location of value creation and economic activity. This line is also very important, wherein we took an example of India, US and Maldives, wherein the value creation and economic activity were based in India. However, they were artificially shifted to Maldives, wherein it was depicted that value creation and economic activity is in fact in Maldives, and accordingly taxes were paid in Maldives, which is a tax haven country. So there should be an alignment of taxation. There should be such provisions which values the country wherein value is created, the economic activity in which country it is generated, it should be taxed in the same country. So in our example, the value creation and economic activity were in India, so taxes should have been with India and not with Maldives. So alignment of taxation with location of value creation and economic activity, substance over form concept, friends. Third point is improving transparency and tax certainty. So When the globalization came, as we discussed, that MNCs were in fear that the same income would be doubly taxed, and there was no surety that how the things will flow and how country to country negotiation will be rendered to safeguard MNC's interest. And thereafter, double taxation avoidance agreement came, and globalization was a success. Similarly, there has been measures. There will be measures. There are measures in action plan of Beps wherein it will be ensured that there is transparency between one government and another government through exchange of information. Also, there is tax certainty with the taxpayers, wherein a proper taxpayer, wherein a defaulter taxpayer should be punished and not good taxpayer. Correct? So there should be a tax certainty which will be ensured by the provisions of the action plan. This is the third pillar of the action plan. So here, coherence, substance over form, and transparency have been noted in detail. Coherence: domestic tax systems are coherent. Yes, currently there is a coherence concept in the domestic tax provisions, but there is absence of coherence concept at times in the international tax law. International coherence in corporate income taxation needs to be introduced. Cut start needs to be introduced, needs to be addressed. Substance over form: present tax laws must be modified, relate to both income and economic activity that generates it. Meaning, in an example, international tax laws should ensure that tax is flowing to the country where income and economic activity are generated. Value, where value is created, tax should flow there. Where economic activity is created, tax should be flowing in that country only. This will be ensured by substance over form, and for that, present tax laws must be modified. Concerns in the area of transfer pricing to be addressed within the prevalent system. One of the measures of anti-avoidance rule is the cut start is the measure of transfer pricing. Transparency: greater transparency and improved data amongst the member countries for quick information sharing, quick exchange of information for a particular MNC. Taxpayers to report the aggressive tax planning arrangements and rules. So transparency between tax administrators and taxpayer, wherein taxpayers will be asked to report their aggressive tax planning arrangements and rules as and when required. And if they are correct, then no issue. If they are not correct, then preventive measures will be taken by tax administrators. Making dispute resolution mechanisms more effective, meaning if there is any dispute between the tax administrators and taxpayer, there should be a quick resolution between the two people, between the two parties, and to make dispute resolution mechanism more effective, action plan has suggested certain recommendations. So, concept of transparency and tax certainty, the third pillar of BEPS action plan. So 15 action plans that we were talking about has been noted down in the tabular form over here. First is digital economy. Digital economy is nothing but example of Google, example of Amazon, Flipkart, wherein Google is involving in online advertisement, and exactly from which country the revenue is generated, it is very hard to trace out. So for that, there is a specific action plan for digital economy. This action plan will be discussing subsequent to these slides in detail. Classification as per objectives, classification of action plan as per the objective. Objective is nothing but three pillars of Beps action plan, and classification as per, this shouldn't be as per objective, this should be as per approach, whether it is a minimum standard, whether it is a recommendatory approach, I mean optional approach. So this header will be changed and this header is correctly reflecting. So digital economy, both are horizontal, meaning it may mean, the horizontal meaning may mean that it may have a meaning that the taxation in the domestic law or the taxation to the of the existing cross-border activities should be placed along with the existing provisions, meaning if you have any existing provisions which are addressing the digital economy, they shouldn't be altered, and the measures which have been suggested in the action plan 1, which is digital economy, should be adopted by the relevant country, by the member country, horizontally, or you can say alongside the existing provisions. Neutralize the effect of hybrid mismatch arrangements. Action plan 2, it is nothing but coherence and common approach. If we go as per the approach, I mean whether it is mandatory or not, it is a common approach and best practices. It will be at the option of the member country whether to adopt such action plan or not. And it is one of the concept of coherence as per whether in which three pillars the same is falling, it is falling in coherence. And hybrid mismatch instruments is nothing but difference between a transparent and opaque company, meaning a one country. We will come to the definitions in detail between the transparent and opaque company, or it may be even that a particular instrument, you can say preference shares, for example in India, let's take an example that it is an equity, however in US it may be that same preference shares are not equity but they are liability. So income from India would be a dividend income, which is a preference dividend. However, the income which is received received in US is an interest income, and let's take an example that in US such interest income is not taxable, is exempt. So in a way, the dividend income is not getting taxed in India as well as in US. So basically a concept of coherence wherein one country, wherein both the countries should ensure that a particular income is taxed in the hands of MNCs. So here you can see there is a practical difficulty wherein the same income will have a different nature in each of the countries. In one country it is an interest income and in another it is dividend. So you can see the difference. It's not that countries are doing it intentionally, it's just that domestic tax law are not in sync with the international tax law, and because of that they are not able to adopt the coherence concept. So this is why post October 2015 OECD has suggested that the domestic tax provisions of the member countries should be realigned with the international tax law so that such practical difficulties can be addressed as soon as possible. Strengthen the CFC rules, which is a coherence concept, and common approaches and best practice. I will just read out the headers as such because anyways we will be going through the action plans individually. At that point of time, the objectives, the approaches will get more clear. So this you can take it as for reference purpose, wherein this will be handy when you have understood all the provisions. We have understood the basic provisions of all the action plans, and then we will try to understand whether what are the objectives of the action plan and what are the recommendatory measures of the action plan. So friends, first digital economy, second hybrid mismatch instruments arrangements, third is CFC rules, which is controlled foreign company rules. They are not prevalent in India. And for this each and every action plan, we will be providing what are the corresponding Indian provisions which has been undertaken by Government of India. So what are the domestic provisions which has been amended, which has been brought in by the Government of India in compliance with such action plan? This will also get covered in the respective action plans. So fourth, limit interest deductibility. Fifth has two parts: preferential tax regimes, exchange of information on tax rulings, prevent treaty abuse. A classic example that we had discussed earlier was India, Maldives, and US. Prevent artificial avoidance of permanent establishment status, aligning transfer pricing outcomes with value creation, intangibles, risk and capital, other high risk transactions. So 8, 9, 10 is related to transfer pricing outcomes, and almost out of 15 action plans you would see that 5 to 6 action plans are addressing transfer pricing issues. So very important that at the time of discussing transfer pricing provisions, these are also discussed. Action plan 11, data analysis. Fifth, mandatory disclosure rules. 13th, re-examine transfer pricing documentation. 14th, dispute resolution. Here you can see these both are minimum standard, 13 and 14. That means they are mandatory to be adopted by the member countries. And multilateral instrument, which is horizontal, meaning it will be read alongside the existing provisions. Cut start, meaning it should be read alongside the existing provisions. So friends, 15 action plans has been noted down over here. As we have discussed, we will have to come back to it once we have understood the basic provisions of each and every action plan. And new minimum standard, revision of standard which already exist, and best practices. As we have discussed, this action plan could be either that certain action plans are mandatory to be adopted and they are known as minimum standards through which the provisions which are stated in such action plans are to be added to the domestic tax provisions or to the domestic taxation avoidance agreement, double taxation avoidance agreement. These provisions are required to be added therein. So to the existing provisions, provisions which are recommended by new minimum standard are to be added. This will ensure that there is no negative spillover on other countries. In a way, if all the countries adopt it simultaneously, then only there will be a benefit out of new minimum standard. If one country is adopting, if one country not, then it is always better that both the countries do not adopt. So ideally, either both the countries should be adopting it or none of the countries should be adopting it. And through multilateral instrument, an option has been given by OECD wherein they should be negotiating the differences between the existing provisions of the respective country. But for minimum standard, they have to adopt. There is no option of reservation or option provisions. Since this is a new minimum standard, these provisions has to be adopted mandatorily by the member countries. And this will ensure there is no negative spillover on the other countries. Members of the Inclusive Framework on Beps commit to implementing the minimum standards and commit to participating in the peer review. And we could start. As we had discussed earlier, the member countries has to adopt minimum standard, and peer review concept is nothing but certain agencies, people will come from OECD to cross check whether indeed the member countries are implementing the minimum standard in the domestic tax provisions or not, in the existing tax provisions or not. Next is the revision of a standard which already exists. So new minimum standard says you add the provision, and at times there will be a revision of the existing provisions also required so that you realign with the international tax law. And best practice is nothing but optional provisions, recommendatory provisions, which has been suggested by OECD. If a particular country wants to opt for the same, they may opt it. Which on the screen you can see common approaches and best practices. So this is the meaning of best practice. So friends, this concludes the background of Beps, wherein we have studied the importance of globalization, the impact of globalization on the international tax law, and the particular MNCs which are into e-commerce business, how they are involving in aggressive tax planning, and how it is impacting the overall countries, all the countries at global level, how it is impacting other countries. This has been discussed. So e-commerce and consequent tax planning, wherein a need for non-taxation has been addressed by Beps. Adverse effects of Beps, as we have seen in developing countries, there will be significant underfunding of the public investment and it hampers the scope of development. Tax fairness issue, one company is paying tax at a 30 rate, however MNCs are paying tax at a negligible rate. So competitively they are MNCs have upper hand. Accordingly, there was a need for international collaboration which has been addressed through Beps, and the final copy of Beps action plan came in picture in October 2015, and between October 2015 till date, respective member countries have been asked to address this issue by way of bringing in provisions in the domestic tax provisions, to keep on changing your domestic tax provisions to realign it with the international tax law. And the three pillars of Beps: coherence, substance over form, improving transparency, tax certainty, then 15 action points. A summary, a tabular summary has been prepared, and in the subsequent slides, in the subsequent videos, we will be seeing each and every action plan in detail. Thank you.